All right, welcome back to our 24th edition of our weekly Wook and Review broadcast, everybody. It's been a wild week out there. It's been a wild couple weeks out there. We're going to talk about what's going on in the rate markets, talk about a couple tickers on the Wookie watch list, and kind of where the economy seems to be headed. So we have a few discussion topics today. It's 4:06 Eastern. We'll probably wrap 5:30, 6 o'clock. Let's see. Um, just programming note up front, I'll be on vacation for the first half of next week, so we'll be skipping our weekly open mic on Wednesday of next week. We will be back, though, with our normal Wook and Review on Friday, just FYI. All right, with that said, then let me reread this disclaimer. Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So, okay, as I said, I've got the newsletter. We've got the newsletter pinned. Joe's got a few other tweets pinned that we're going to talk through. Again, if you want to actually bring the newsletter that was sent out this morning, if you are not receiving it in your email, you can sign up. It's free. Comes out around the market open, 9 or 9:30 on Friday mornings. So we're going to kind of use that as our roadmap for today's discussion, but we can certainly entertain any topics that are not in this write-up. So I have on my screen, as I mentioned, if you're in the Wook Discord, you can follow along. Otherwise, I'll just be kind of discussing some stuff that's probably already pinned here in the nest. It was a absolutely chaotic week in terms of volatility, specifically in the bond market. Right, we had last weekend the news out of the Treasury, the Federal Reserve, and the FDIC on Sunday night that they would be wholly backstopping uninsured depositors. So they took a really massive action. The bank did not meet systemic risk levels from a size perspective, but the regulators decided, and I think made the correct decision, that it would have blown up into a systemic problem had they not taken the action that they took on Sunday. Now, we can kind of talk about some of the bag of worms, can of worms, whatever the saying is, that their actions may have opened up. But for now, we've got some challenges with Credit Suisse, but Credit Suisse is kind of its own making. It's not the same issues that Silicon Valley Bank and some of the other banks in the U.S. are facing. So that one is still up in the air a little bit. Last I saw, there might be some resolution that involves a kind of a shotgun marriage between UBS and Credit Suisse. But as of this point in time, I haven't heard or seen any of that finalized. But on the state side, right, we have Silicon Valley Bank still, as I've seen it, asset sales haven't been concluded. They are obviously looking to find buyers of the bank assets, but uninsured depositors are fully covered. Again, I think that's the main thing here. They're trying to prevent a broader systemic bank run kind of across the system by backstopping all uninsured depositors. I think they've tried to send that message again, although that means now if you're not on deposit at a systemically important bank like one of the big banks, as one of the senators kind of raised the question to the Treasury Secretary, and yesterday, I think it was, pretty pointedly, why would anyone keep a deposit at a regional bank if you guys are effectively saying that big banks are backstop. So I think there's some moral hazard questions worth exploring. But before we go into all of that, let me go through kind of some of the prepared content, and then we can circle back because I think that one is going to be the bulk of the conversation around all the craziness with the yield curve. And we included it in the newsletter. As you can see, if you're following the screen, you can see the move index, the implied volatility in the bond market. And on Wednesday, it got within spitting distance of the all-time high reached during the GFC. So it hit 199 on Wednesday, and the high in the GFC was it was over 250. But these are extraordinary levels of volatility. Bond volatility's been high basically since the start of 2022, when the Fed kind of shifted gears, recognizing it was behind the eight ball of inflation and began its rapid hiking cycle. And bond volatility has been pretty elevated since, with just a huge move in the last couple of weeks here. And the volatility is because of the huge uncertainty around what is the direction of rates. It was multiple sigmas of rate moves on different durations along the curve, whether the 2-year moving up and down just massively. I had included another image in the newsletter. This was in John Author's column. This is just from the Bloomberg World Interest Rate Probabilities function, but you can see if you're looking at my screen, or if you got his newsletter, kind of just showing from March 6th through till last night, the shape of the Fed funds futures kind of hike expectations. And just incredible that how rapidly things shifted from when Powell spoke to Congress last week, the beginning of last week. It feels like forever ago. There were at one point over 4 hikes, 4 incremental hikes, over 100 basis points priced in by the peak, the terminal, and then at this point we're really looking at maybe they do too. There was reporting from Nick Timiraos out of the Wall Street Journal. I know some people like to disparage Nick. I've been, as a reader, following Nick since I was an undergrad during the GFC, and I think Nick does a very good job covering the Fed and the economy. And I think the comment from Nick was along the lines of, if there's no further escalation of this, or if there's no further spread of the contagion, that they're going to raise 25, which I think I'd made similar point. The 50 is obviously off the table. I think 25 makes sense, right? The ECB moved forward with its 50, assuming that there's no further bank failures between now and next Wednesday. You're probably going to be locked in with that 25. Now, the interesting thing will be, and we'll talk about it next Friday, of course, what does the Fed updated summary of economic projections look like? So, a lot to talk to about on that front. But let me get through the couple companies that we wanted to talk about their results, and if anybody wants to chime in on those before we continue the discussion on kind of what's going on in banking and in financial markets. So we noted, right, that we have this Wookie watch list. We still are pending completion of I think if you're familiar with the Roaring Kitty, we're trying to kind of recreate that model. We're not as great of modelers as he was or is, but we're going to basically put something together that folks can kind of in a Google Sheet access, hopefully a useful little tool. And the watch list I have on the screen, obviously it's sent out in the newsletter. I'm not going to read all of the tickers off, but we're going to cover 2 tickers that had meaningful news this week that are part of the watch list. So as everyone may know, PLBY Group is the one security that Wook Capital's publicly disclosed our holdings in. So we continue to cover that. We had a Spaces discussion last night, so I won't spend too much time on this. If people want to ask questions, they're welcome to. If they want to make comments, they're welcome to. But we had a pretty good 2-hour conversation last night that I think we covered just about everything. I'll kind of note the highlights here briefly. The earnings were pretty piss poor. The CFO is leaving. Unfortunately, the CEO is not leaving. An investor I spoke with today has a call with the CEO that he started 15 minutes ago. So I'll be curious to hear if there's any interesting update that perhaps I get while we're in this conversation. But Regardless, the operating results are pretty dismal, but they gave us some operating detail on their creator platform finally. So Ben Cohn noted that the current run rate GMV for the platform is around $15 million. And with the growth rate that they are seeing and have been seeing over recent weeks, they expect to achieve a year-end GMV run rate around 45, 50 million, which, the economics of that are pretty favorable once you scale it. It's they're providing a place for creators to post suitable for work pictures, videos, engage with their fans through messaging. So it's like a cleaner version of OnlyFans, which, they have at least one creator who's seen success and realized more than $1 million in um, uh, GMV themselves. And the model is such that they have a pretty low fixed cost base once they scale this thing. It's about 500,000 a month they quantified in fixed costs, so about 6 million a year. They do, of course, incur variable costs for credit card processing and for hosting, which are mid high single digit of revenue. So, they take a 20% cut of that GMV. So in their, kind of projection, if you get to 45 million, $50 million, you're at 9 to 10 million in revenue for the company, less out the 6 million in fixed costs, less out the 3 and change million in variable costs, and you get to neutral. So, that's the growth story. That's clearly where their focus is. The thing that we heard differently from both the CEO on the call and also from kind of my conversations that I noted last night with other investors leading up to this who've spoken to the chairman of the board is that if they do not succeed in achieving their targets for the creator platform, I believe they will part out what's left of the company. They already noted they're going to sell their costume website, yandy.com. They're going to sell, they're undertaking a strategic review, but they're likely to sell their lovers business. I think that those two will net something like 20 million. Now, the current enterprise value is around 300 million at today's close. So back out another 20 from the sales of those, and you're talking about 280 for Honey Birdette and for Playboy's IP and licensing business. Honey Birdette, 84 million rev, mid high 20 millions in EBITDA. It's a pretty good business. They shared some detail. I shared a graphic of the detailed breakout that they shared in their deck, kind of highlighting that the US stores are outperforming the Australian stores. It is an Australian initially based business. They only have 10 stores in the US, but they're seeing much better performance from those stores. The question is just, can they invest the capital and can they be diligent stewards of it? The market has said no, they can't. I do believe if they were to sell the business today, they would get north of 150, probably north of 200 million, which then leaves you with a licensing business is generating, $45 million in EBIT at an implied enterprise value at that point of like 80 million, right? Assuming a 200 million now. So it's just severely disconnected from some of the parts analysis. I believe they will sell off the remaining businesses before their debt covenants come back into play in the second quarter of 2024. Again, of course, though, it made an all-time low, and no one is interested in the company, especially with the current CEO still at the top. I do believe it will, though, be a multi-bagger return from current levels, which isn't to say much if you're like me and Wook with a double-digit plus cost basis. I do not believe that we see the stock trading in the double digits again, but going from $1.75 to $7 is a pretty good return for equity, which is kind of something I expect to see. So that's some thoughts on Playboy, PLBY. We can, if anybody wants to talk about it more, we can. But as I noted, we had a 2-hour call about it last night. So let me move on to the next one, AMC, which we know people are still fascinated with. There's an update this week where we talked a couple weeks back about this peculiarity of they issued the preferred equity units, the apes. The apes then because the company was limited with how many common shares it could sell, it kept selling the ape preferred equity units. Now it's more dilutive for shareholders for them to keep selling these apes that traded at a discount to the common stock. So there was a convoluted scheme wherein the hedge fund owners of the preferred equity units basically were made to vote yes to close that arbitrage. The vote succeeded. So there will be a 10-for-1 reverse split. APES will be converted back into AMC common stock. And of course, most importantly, shareholders authorized the sale of many more hundreds of millions of dollars, or many more hundreds of millions of shares of AMC common stock. So the next step from here is there's a Delaware Chancery Court hearing on April 27th, basically around whether these the usage of the preferred equity units kind of to give those voting rights violated common shareholders' rights through the whole scheme. If anybody wants to talk about it, chime in on it. Again, happy to. I think we're just kind of flagging it because, again, we're going to kind of flag any of the interesting news that affects the stocks in the watch list that we noted. But obviously, this is not a comment on AMC as an attractive investment opportunity whatsoever. I still think equity likely ends up worthless. It just continues to be a fascinating display of what happens in capital markets, and you have a lot of new people enter. So that's what's up with AMC. And then, I think we can now kind of open it up to the banking related discussion that hopefully some of the folks in the audience want to talk about. I saw Jiro in here. I'm not sure if he stepped away. But it's kind of crazy to me, and I see there's some folks who I was in the spaces with making comments earlier this week that energy, right, commodities, oil, a lot of this stuff traded down really big time in the last week, and it's like how much of that is a byproduct of deteriorating fundamentals versus and potentially a deteriorating fundamental outlook, and how much of that is a byproduct of hedge fund positioning, trend follower positioning. I'm inclined, and I made this comment, that when I saw the refiners trading down so meaningfully, even though crack spreads haven't deteriorated meaningfully, that it seemed like the market was pricing in that there would be a very meaningful deterioration in economic activity. The question, of course, is, will there be? And I think I've made my point that I don't believe that the crisis expands from here on the back of the rapid action taken by the regulators last weekend. There's clearly going to be other financial institutions that have their own issues, but if you're going to backstop depositors, that should mitigate the risk of a deflationary, destructive bank run. And of course, the Federal Reserve was initially put in place to prevent bank runs. So I don't think it should have been a surprise that I think they made the right decision. I think there are, again, as I noted, some kind of Pandora's box effects of what they did. But if you don't think that the economy is rapidly deteriorating, then it seems like some of the sell-off is overdone. Obviously, there's also the big rate moves. And Jiro, I see you're up here, so I would welcome, because I know you're a credit guy, your thoughts on the matter. But in the context of these huge rate moves, right, the NASDAQ over the last 5 days has meaningfully outperformed the Dow Industrials as well as the S&P. I'm looking at a 5-day going back to the beginning of the day on the 13th, and NASDAQ's up almost 6%, whereas the Dow is actually down 20 basis points and the S&P is up 140. So I think that is a huge, just people systematically, you see the rates come down and the assumption is, 10-year goes down, that means my tech stocks are worth more. And sort of can understand that, but it's also incongruous with the big sell-off in commodities and oil and what I was just talking about. So someone's right, someone's wrong. I noted in my personal account, I've been a buyer of energy this week, and I bought some value stocks as well today and this week. So I'm making a bet that the economy is not about to enter a Great Depression, but because I did that, unfortunately, it probably is. But Jiro, it's always nice to talk to you. What are you thinking about these crazy moves in rates? Is volatility is the top in for the MOVE index, or are we going to have a GFC?
Hello, Rod. Unfortunately, I don't have a crystal ball like you as well. Yeah, I believe that the market is very nervous. So every time something negative hits the news, I believe that we overreact a little bit to it. And I shared a tweet in the Nest, and I just wanted to. The only reason actually why I don't have Credit Suisse on this chart is because the Credit Suisse credit spreads are so high that everything else is just a line at the bottom, right? So how do you say? So for comparison reasons, I couldn't fit Credit Suisse on this chart basically. So what I'm trying to say is that Credit Suisse looks very idiosyncratic, right? So uh, Friday last week, the focus was solely on SVB, right, on Silicon Valley Bank, and then it slowly shifted. I believe on Monday it shifted to Credit Suisse, starting with I think they entered the headline that in the balance sheet in the last 2 years they how do you say they noticed how do you say they noticed that the balancing was maybe not 100% correct, right? I don't know exactly the term. I can look it up later.
Yeah, for Credit Suisse, they had noted, what was it, on Wednesday night late, that they had material deficiencies in their
Yeah,
audit process.
exactly. And then the day after, I believe, right, that the credit spreads jumped like crazy. So I noted it down here in the tweet. Like if you average out like the spreads from all these major banks like J.P. Morgan, Bank of America, then also European banks like HSBC, BNP Paribas, Barclays, Banco Santander, Deutsche Bank, uh, the credit spreads increased somewhat, of course. I mean, it increased, especially for Deutsche Bank, it increased, right? But on average, it's still only 0.65%. Yeah, so even after all this news, 0.65% if you want to buy a protection
And
against
Giro
default of these kind of
for
bonds. Yeah,
yeah. Sorry to cut you off. I think you were just about to
sure.
say it. So you noted it's 1 year credit default swaps, and for folks who
Correct.
don't know what that functionally means, you're about to say default, but could you expound on that?
Yeah, sure. So basically, it is you buy protection or you buy insurance, basically, right? Let's say you hold a Deutsche Bank bond, yeah, and let's say you paid $100 for it. In order to buy protection against it, against the default, right? You would pay, what do we have here in the charts? Let's say it's roughly 1.3%, right? You pay 1.3% insurance, or let's say it's 1.3 dollars basically. And if Deutsche Bank defaults, then you get your $100 back. Yeah. For Credit Suisse, if you want to buy insurance, yeah, you have to pay almost $31 protection in order to get $100 back. Yeah. So this is very close to probably recovery levels, right? I don't know what the average recovery level is for a bank. Let's assume, I don't know, how do you say, let's assume for simplicity's sake, it's 50%, right? So it's very close to default levels already, right? I mean, if you only look at the market pricing, it's very close to, how do you say, it's very close to pricing a bankruptcy. Although, how do you say, although the Swiss regulator actually already said that they would get help, and they already received help, right? So it was actually very interesting to see that the CDS
Right, it
spreads
was
are still so
50
high.
billion francs that the Swiss
Yeah.
National Bank was basically lending Credit Suisse. And I saw that, again, this is your forte, not mine, but I saw that they were kind of going out in the market and buying some of their discounted debt to try and, I think, show markets a sign of strength, right? That also happened.
Yeah, I mean this one. I say because first of all, I have to say I'm not so. I'm more macro than credit, right? So
Mm.
this news I didn't read, Rod. So maybe you can tell more about that part.
Yeah. Hang on. It was, I think it was in Matt Levin's write up from yesterday. Uh, there's so I don't have it up. So keep going. Keep when
Yeah.
I find
Okay.
it, I'll
Sure.
yeah.
Yeah, I mean, I just wanted to highlight, right, that the situation in Europe is very different because we don't have this focus on, how do you say, on all these regional banks, right? I mean, what I heard in the US, you almost have 4,000 banks or something like this. I mean, the big ones, and then how do you say, and then 4,000 smaller ones. Um, in Europe, it really looks as though Credit Suisse, at least the market is pricing that Credit Suisse is a idiosyncratic event, and all the other banks look actually fairly healthy. Um,
And Credit Suisse is it's it's on the back of like just blunder after blunder that they experienced in 2022, and I think maybe some of 2021. Right, there was the Bill Hwang blow up where they ended up holding the bag on several $billions of losses
yeah,
from Archegos. There was the Green Sill scandal and fraud that they took a big loss on. I know there's others, but it's not like it's the same issue with held to maturity loans depreciating in value. There's just a lot of um, idiosyncratic loss that they as a business experienced, and yeah, they are systemically important, right? So they are quote unquote too big to fail. So you've got, I think, the Swiss National Bank, right, injecting this. So I found what I was referring to. Credit Suisse came out with a tender offer on 1.9 billion in 1% US dollar notes that were due in 6 weeks. So they traded. Yeah, this was, I guess, Wednesday. They were trading at 92.6 cents.
mhm.
So they were yielding about 60%, which is absurd. But Credit Suisse was basically tendering to buy them for those at 98 cents on the dollar. And then on some other notes, that were trading at 84 cents. They were offering to buy them at 90 cents on the dollar. So, and they were going to save 70 million in interest costs, by buying back the debt at those levels versus holding to maturity. So obviously, with the funding from the Swiss National Bank, it's like it's trying to convey to the market that things are okay, and by effectuating a trade to show that things shouldn't be as distressed as they're trading. I think is the tone from Levin. And again, I'm not trying to claim to be an expert on this, but which I think makes sense. He says, "quote unquote," Credit Suisse's main goal right now is to convince funding markets that everything is fine. If you want to convince traders of something, the best evidence is a trade. The market is telling Credit Suisse that its debt is distressed. Credit Suisse wants to tell the market that it isn't, that everything is fine. The way to do that is with price. So that's kind of where the offering and those actions that I was referring to came into play. But to your point about how wide the default swaps still are, it seems like from like the sum total of what I've read, even though they don't want to, it almost seems like this UBS Credit Suisse combination may be the best step forward. But as you said, we don't have a
Yeah, but I
crystal
think
balls.
UBS doesn't want to
Right.
merge with Credit Suisse. That's the issue, I believe. Um,
But
yeah, but
mhm.
I think what else did I want to say? Yeah, but just as a bigger picture, maybe, yeah. Um, because why is the market panicking so much about the banking sector, right? Because if we had issues in the banking sector, because it's such a big part of the economy, right? Because if credit conditions tighten, then people would buy fewer houses and people would not become self-employed, and it has a lot of consequences, right? So I totally understand the initial panic reaction, but as we see now that it looks fairly idiosyncratic, I think that move is fairly overdone, and actually the effect on GDP will probably not be that big. Also, I mean, what is interesting to note is actually looking at this
And
rating.
to
Yeah,
expound on your point, and
yeah,
Katie, you're welcome to chime in a second here. But your point about financial conditions, at least per like the Bloomberg index that they put together, there was a huge tightening. So to your point, that does help in some sense the Fed achieve its goals, of helping to reduce aggregate demand uh, through this financial condition tightening. But yeah, I'm inclined to think, like what you're saying, that the real economy is unlikely to be meaningfully damaged unless, this contagion spreads further, which I still think that they've done a decent job controlling it, but for this open question mark of Credit Suisse. But Katie, would you like to chime in?
Hi, thank you so much, and I appreciate this space and for allowing me to come up here and speak. I am by no means an expert at all in this realm. However, interestingly enough, I spoke to my. I'm going to sound so silly, but at the risk of sounding silly, I spoke to my dad yesterday because it was brought to my attention not long ago about the UK government's initiative to digitize currency. Um, and I immediately, after the news broke about what was happening in the US, I turned around to my dad and I said, "This is part of the plan, I think, where perhaps, not to sound like a conspiracy theorist, and this is why I'm here to gain insight and further understanding, maybe, but to in some way would this incite fear and panic and then provide the solution by digitizing currency because it's all on the government website, the digital pound, a new form of money for households and businesses. And this is that article was from the HM Treasury on the 7th of February 2023. But people have been speaking about this online, predominantly on TikTok, really, but about the UK's initiative to digitize currency. So I'm curious to hear your thoughts.
Um, yeah, I on the specific to the UK, I don't have any insight or thoughts. Specific, I guess, more to the US, like a central bank digital currency. I mean, I'm not of the view that the Silicon Valley Bank run was um, planned by some central authorities to allow the introduction of a CBDC personally,
Right.
but
But didn't HSBC buy them? Or,
HSBC bought the UK portion for what, a pound? Yeah.
right. Yeah. I just find it very interesting, but I'm like I said off the bat, I'm not an expert in this field, and that's why I enjoy spaces such as this one that you're discussing it. But you know, much like I don't know if you remember this, but back in the day when we used to pay for things by credit card, there would be that swipe machine and there'd be the carbon paper and stuff. And the idea or thought of tapping a card was horrifying to some people. They're like, no way, this is so scary. But look at the evolution of finance. That's the world we live in today. So could this possibly be the um, you know, soft kind of launch into digital? I don't know.
Yeah, I mean, the trend seems to be in the direction that countries want to have this optionality. I'm not an expert on CBDCs, though. One thing I would add, it's a little tangential to the specific point you brought up, but in line with the Credit Suisse discussion that we were having. I hadn't seen this Reuters exclusive. It came out 3 hours ago. The headline is Credit Suisse to hold internal talks this weekend on scenarios for bank. So again, they obviously got the loan from the Swiss National Bank after the bank run that they experienced. They've, as Giro has pointed out, still got obscenely priced credit default swaps. So the possible scenarios that they're citing in this reporting are that Credit Suisse could sell or wind down some of its existing businesses with a breakup potentially in the cards. There could be an outright takeover by a rival, read UBS. But they're going to have this kind of going on over the weekend, so we'll presumably get more reporting as it occurs. I don't know if there's anyone in the audience who has any deep insight into central bank digital currencies or an informed view on where things are headed. But again, I guess just broadly for the system, I mean, the CBDC discussion is more like, to me, it's interesting, yeah, sure, and I get that a lot of people are curious and concerned about it, but the most important thing is that there isn't some contagion wherein you start to see many banks failing, and that is where you could see something descend into a GFC's type situation. I mean, at this point, at least stateside, I'm not getting that sense. There was the reported on yesterday that a bunch of the big banks, the Treasury Secretary worked with Jamie Dimon, and who kind of put together this consortium of banks to support First Republic Bank with this $30 billion in deposits at market rates. So like they're definitely doing their darndest to reinforce confidence in the banking system. But as Giro noted correctly, none of us have a crystal ball and know how it's going to play out. But never right. There's been issues. I tried to bring you up. You requested it. There's been issues with Spaces for like a week or so now, where if you're on an Android device, I don't know why it causes problems. So if you are, that might be why I'm having trouble adding you. Sorry. Get mad at Mr. Musk, not me. But again, if anybody who's in the audience wants to come up, chime in, talk about kind of rates, CBDCs, what's going on with this whole kind of crisis, if you will, you're absolutely welcome to.
But I guess, can I maybe ask Katie, what is the theory behind the CBDC thing again? Because central bank digital currency. So what is the end goal? Because isn't Bitcoin attractive because it's not controlled by a central bank? And how do you say? So what is the theory about?
Oh, the theory.
Yeah.
And thank you so much, and nice to meet you. I don't know. I mean, I'm just merely, but somebody that is not an expert in this field, but having witnessed and continuously watching the way that certain strategies are rolled out, I think that basically, I mean, it's all on the government website here in the UK. Their intentions are to digitize currency, but it would essentially lead them to have control over it, meaning that let me pull this up real quick because I've got it in front of me right now, because I was just looking up Credit Suisse. The digital pound. So the consultation paper sets out an analysis by the HM Treasury and the Bank of England on the potential case for a UK central bank digital currency. Unlike crypto assets and stable coins, the digital pound would be a central bank digital currency, or CBDC, which we're talking about now, which is what the UK do not have, I believe, but correct me if I'm wrong. Like I said, I'm not an expert. But there were talks about how it is controlled in terms of when the changeover happens, those that are in the higher, I guess, earners bracket, or those with more savings, or so on and so forth. And again, I have to fact check, by the way. I'm just talking off of memory and not with this right in front of me. That the conversion will provide a buffer, so to speak, so you can convert up to X amount into digital, but anything else is going to be withheld by whoever it is. Again, I don't want to say unless I have it verbatim in front of me, in which they'll use then as this buffering system until everyone seems to be sorted out, and then things get lost in translation, so to speak, and so on and so forth. And it's a bit of a wishy-wash thing. So it was merely by the research that I had done after listening to an interview on LBC, which is a news radio station here in the UK. And they were talking about this, and I mentioned it to my dad, I would say probably like 6 months to a year ago. And I said, did you know that they're going to be doing this? And he was like, no, I didn't. And that's why when he mentioned to me that HSBC had purchased for £1, like the UK side of things, and the minute I saw the banks in trouble in the US in the news, I just immediately kind of went to, oh no, this is not that, oh no, I mean, maybe it's a good thing, I don't know, but I wanted to learn more about it, but it's been playing on my mind.
So Katie, I don't mean to cut you off. I was going to say,
It's okay.
I'm aware of, at least in Nigeria, for example, they had introduced a CBDC recently, and I'm sharing from an FT story this week, noting that So quote, in countries where CBDCs have been launched, adoption has been piecemeal. In Nigeria, less than 0.5% of citizens used the e-Naira for more than a year on from its October 2021 launch. They have a Nigerian economist who says, quote, people are skeptical about it and afraid of their money disappearing without anyone to hold accountable. So I think kind of in line with maybe your general thinking is, this is something people don't necessarily have a good grasp of. They are fearful of, they're uncertain around, and therefore they're unlikely to use. And thus far, that's panning out in the data. The story also notes that in China, they've done some pilot programs, to try and challenge Alipay and WeChat, and the results were from the People's Bank of China official, quote, not ideal. So, where it goes from here, I think it's hard to force people to use something they don't want to. And it
What
does
happened to
seem
the days where we hide our money under our mattresses? Do you know what I mean? I shouldn't make light of it, but you're right in saying that. I think that, and again, it's so important for you guys to open these spaces for people that aren't necessarily knowing, such as myself, to learn a bit more. So, if there was some information or guidance or words of wisdom that you would be able to provide anybody, it would be greatly appreciated. Kind of like not in regular terms, but we're here listening to all of you guys, and gratefully so. And we're trying to grasp like a better understanding of things, and I appreciate that a lot.
I
Yeah,
invited
but
Mr. Vestro. I don't know if you have any thoughts on CBDCs. I know you've been in the space, and Joe, I know you've kind of been interested in the crypto blockchain space for many years. So I don't know if you have any thoughts on
Yeah.
CBDCs.
No, I haven't really explored that at all. I'm still holding my Bitcoin. I purchased years ago, you know that, and I sold my Ethereum position in, let's see, when was that? It was over 4,000, so did well on the Ethereum. I had purchased that many years ago, and besides that, Bitcoin has actually had a good day. So if you're into crypto, you can't be too mad today.
I think broadly, though, to respond to the thinking, I think that the rightful fear would be that there would be some conversion away from, banknotes in all in on these CBDCs without at least, I just struggle to see things going that way. I can't envision that the UK or another nation is going to basically, against the will of its citizenry, try to force them to use these. And that they should do that at their own risk, having seen these early results kind of not being so favorable. But in terms of like knowing what the plans to move forward, I mean, to your point about what happens in England, I'm seeing in this reporting the BOE says a final decision on the adoption of Bitcoin will be made in 2025, and there's obviously no certainty around whether that would move forward or not. So it's certainly not an overnight imminent thing, but yeah, I mean, again, if anyone has any insight, expertise to add to the conversation, we welcome it. Chris, I see you came up. I don't know if you wanted to add anything on the topic or Zero. Let me pause and shut up.
You maybe just a word on Bitcoin. I mean, the reason why I really enjoyed trading Bitcoin was actually because if you have a macro view, if you have a central bank view, then it is such a amazing asset because it's high beta, and if you have an opinion about rate hikes or rate cuts, right, it trades so well, if you're right. The only problem that I have is the idiosyncratic risk, right? So every time there is an exchange problem, with FTX or Binance or whatever, right? So it really messes up actually your macro views. So this is my only complaint that I have. So that's why I stopped trading Bitcoin.
All right. Well, I'm gonna shift the conversation a little away from the blockchain crypto CBDC and back more toward macroeconomic. Lost in the sauce of all the craziness with the rate moves and bond market volatility has been some incremental economic data that I think show the Fed's mission is they're moving closer toward what they want to see. So on my screen, and I think retweeted, quote tweeted somebody on this earlier this week, you've got the New York Fed does a survey of like 1,300 households, and this is their inflation expectations, what they think inflation rate is going to be in 1 year, in 3 years, in 5 years. And you can see the graphic if you can, and if not, you can kind of type New York, it's newyorkfed.org. You can just type like New York Fed inflation expectations. But you'll see that last month in February, there was a significant deterioration in expectations for 1 year forward inflation. It fell from 5% to 4.2%, which is of course still higher than the Fed's target, but 80 basis point decline in 1 month shows that the trend is in the right direction. And the 3 year forward expectation is still down now to 2.7%, which is pretty much smack dab where expectations had been before COVID, before inflation, and for the bulk of the preceding decade. So like in isolation, one metric that implies that consumers are sensing that peak inflation is in the rearview mirror. And then, of course, you got producer price index data that came out this week that declined month over month, as well as consumer spending that declined month over month. There's some stuff in the pipeline looking forward around, at the end of this month, there's millions of people who will lose some of these emergency Medicaid benefits from that program ending. There's the student loan, when you think about stateside consumers and creditors who will have to begin repaying their student loans at some point in the third quarter. So like, I know that the headline inflation figures are of course still high. I guess my sentiment is that when you look forward about what people are expecting and what is happening, those producer prices do tend to flow through. Now, we had a good conversation, I think, last week about this idea of the excuseflation, where companies are still taking price despite their input costs coming down. So it will be interesting to kind of watch as next round of quarterly earnings come through and we see first quarter results. Because another reason for, I think, some of the movements in the equity markets are that people are maybe realizing that their earnings expectations had been still too high and that they need to mark those down further. So if earnings are coming down, if spending is coming down, that is good for the goal of getting inflation under control, but maybe not so much for equity valuations. So there's obviously a lot of moving parts. I don't know if anyone has any thoughts or any other economic data that they would add on that or push back on that notion.
Yeah, maybe I just want to highlight a couple of events next week. Yeah, so we have a lot of PMI data actually in Europe, and most of them actually look pretty positive. And then of course we have the Fed decision next week. So with respect to how the economy looks, and everybody's always talking about lagging indicators, forward indicators, and PMI is more forward-looking, right? Especially the new orders component. So if that is still looking good, then actually I'm not so worried.
Not so worried about the real economy, you're saying?
Yeah, because I think okay, so within a week, we went from pricing a terminal rate of 5.8%, so close to 6% actually, to now pricing almost no hike. I mean, on Tuesday it's a coin flip now between if they hike by nothing or if they hike 25 basis points, and then the market is pricing in 2 aggressive cuts of 50 bips, I believe, until the end of the year, right? And this is only because of a week, and this is only because of Silicon Valley Bank and of Silvergate and a little bit of Credit Suisse, yeah. And I think as quickly as we moved from bullish to super bearish, right? We can also have a complete different move, of course, in expectations, right? As soon as we see the economic data still coming in pretty strong. And also, like, if we look at the Q1 nowcasting model from the Atlanta Fed, and we already have the, I think it was updated until the 16th of March. So it already incorporated a lot of data, yeah? They're already seeing 3.2% real GDP growth, which is super strong. Let's say it's optimistic. Let's say it's plus 2%. It's still amazing. So, so without negative GDP growth, without a huge increase of unemployment, we'll not have a recession. And these are the two things, the major things that will determine if the NBER will declare a recession or not. And what I did actually yesterday or the day before yesterday when I created a recession model is actually that my model is actually predicting a recession for 2022, when we had two consecutive quarters of negative GDP, yeah, because this was in the test data set, yeah, and I think it is just very telling, right, that it's the first time that when you had two negative GDP growth prints that the NBER didn't declare recession. So okay, you can say because unemployment was still very tight. Fair enough, right? But it's just when you predict something, with historical data, it's just very annoying, right? When the rules
but there
all
was
of a sudden
also a
kind
lot
of
of
change.
noise last year where those prints,
Yeah,
they were
I
negative.
agree.
You're right, but there was a lot of inventory, like import, kind of detracting away from the net number, because of course, if you're importing things, that reduces your GDP. So, and I think
this was also
they
the
made the correct
inflation print. It
decision.
was also the very high inflation.
Right.
Yeah.
Yeah, I think it was the correct decision. I mean, reality is it certainly didn't feel like a recession. And
I
don't
agree,
know
but
that
I'm
can
just
have
saying
a
when you
recession.
work with models, right? It's just
it's
just very
your
annoying
model
when
doesn't know.
when GDP is the strongest indicator, and out of a sudden it's almost. I mean, I wouldn't say it's useless, right? But it's not that valuable anymore, almost.
Well, it gets just back to how unprecedented this period is of coming away from a worldwide crisis where you didn't see the destruction of the productive capacity of countries, right? They just shut things off, and yes, older citizenry disproportionately died, but those are also not members of the labor force to be mechanical about it. And we had all these bottlenecking and bullwhips kind of happen. It's still just. I think that's part of the reason why maybe people were so kind of having seen what happened in GFC and thinking like the end of the world. We just got so much fiscal and monetary stimulus though that kind of mitigated that. But now, of course, we're dealing with the repercussions of taking rates from 0 to 5 in a year's time, and what that does to bank balance sheets. And that, I think, is where like the BTFP program that they put in place, where banks can basically tap the discount window with the par value of these securities, whether mortgage-backed or treasury bonds, these high-quality securities, but these securities that are trading at 60, 70 cents on the dollar, they can at least now lend with the Fed at par. So I think like that program is it makes sense to me that they would do it, but again, it's only buying a year, right? And what happens? Do we get into a perpetual state where you have this sort of a program? I don't know. So, I mean, there's definitely a lot of questions still out there. Chris, you came up. I don't know if you want to chime in on this topic or on another. Chris R. Bueller. Silence. JP, nice to see you up here as well, sir. Any thoughts?
Right. I'd just like to remind everyone, I did pin the poll. If we can get, you see the responses, check them out. We have 24 responses on the poll. Is the bank crisis over? Curious what everyone thought. Let's see if I hit, you can see we had 28% people said yes, 72% of people said no. That's 25 votes. I'll pin that in the front of the nest too if you guys want to chime in. But yeah, it looks like most people are saying no.
Thanks, Joe. Yeah, if you guys want to take that poll, it does look like about 3 out of 4 are saying no, the crisis isn't over. Director Media, hey, how are you?
Good. How are you?
Just thriving. I'm about to go on vacation tomorrow, so I don't care if Credit Suisse blows up.
Oh, I don't think that would happen, right?
I don't think so either.
Yeah, that would not happen. I'm looking at well, it just disappeared, but it seemed like somebody like DB stock. Is that right? No.
I know Giro had put up some credit spread information, credit default swap information.
Yeah, correct. It was CDS spreads. Yeah.
Yeah. Oh, so you're measuring in CDS spreads?
Yeah, I just wanted to how do you say? I just wanted to highlight that actually the European banks or the global big players look pretty fine, although at least the market thinks that the default probability didn't increase significantly, only because credit, how do you say, like Credit Suisse or Debit Suisse, as many people call them now, is in trouble. Yeah, I'm just saying that.
Whatever you want to call it.
Yeah.
So, do investors think that? I guess my question there would be: do investors think that the credit default swaps are relevant products in the case of a potential bail-in? Isn't that kind of a weird situation?
Yeah, I agree. Because if the government is actually guaranteeing that they will bail Credit Suisse out, then actually the spreads should be much lower, right? So I agree.
Yeah,
It
I don't
feels
know.
a little bit weird that it's still. Oh, by the way, update. It is now trading at 39.16%. So almost you pay 40% insurance to get 100% back. So.
Well, that is the big mystery on my end. So I will leave people with that. I have some other things I'm working on. But thank you for the floor.
Sure thing.
Sure, cool.
Yeah, I don't know if you were in the room earlier. I noted that the reporting a few hours ago was that Credit Suisse will have internal talks on scenarios this weekend. So whether there's a resolution by Sunday, obviously no certainty around that. Yeah, if credit default, if CDS is now, as Giro said, just blowing up to the moon, you've got to think that whether it's a forced marriage between them and UBS or the Swiss National Bank does something more, it's probably not it's not a satisfactory status quo for it to stay at.
Yeah, or it could also be that the market is knowing something that we don't know yet, which is not in the headlines. Maybe there are certain rumors that we don't know about yet.
That's impossible in Europe.
I saw Bill Ackman commented something along the lines of Bank of America would be buying First Republic Bank. Let me pull that up again. I have no idea how much veracity there is to that. Quote, this is Bill Ackman around 1 o'clock this afternoon. I am hearing that Bank of America is going to buy Signature Bank. Mixing it up. Going to buy Signature Bank on Monday. Unless and until we can protect uninsured deposits, the cost of capital is going to rise for smaller banks, pushing them to merge or be acquired by the SIBs, the systemically important banks. I don't think this is good for America. That's Ackman's take. However, a source familiar with the matter told Reuters the Bank of America is not interested in buying Signature Bank. So take that rumor and add it to your mill. Yeah, but like in terms of like I guess like real like live economic data, I had seen commentary that like credit card like live credit card data was not showing that consumers were yet you know pulling back meaningfully on spend as though it were an out of control crisis. So it gets back to the reality: if jobs aren't being lost and consumers continue to spend, does this matter? I would say, so long as it is contained, no, it shouldn't. And the underlying real economy should continue forward. As Jiro noted, it's right now in the Atlanta Fed GDP now showing 3.2% for the first quarter. Whether it comes in the high twos, low threes, whatever, it's still above trend. It's still a little hotter than the Fed I think would have liked to see. It will be curious to see what their year-end projection of unemployment looks like, because at the last Fed meeting, which of course Senator Warren noted in her questioning of Chair Powell last week, that the Fed expected that unemployment by year end would be higher, and the implication that several 100,000 million Americans would be out of work. So we're just not seeing that yet, even though we continue to see the headlines around the technology layoffs. And yes, I mentioned last week that like some sectors are seeing slowing. I've mentioned truck transportation, and in particular, saw the biggest drop month over month, and a third highest drop in a decade, month over month, last month's data set. So there's some slowing in some spaces, but like construction is not falling off a cliff yet. These blue collar labor is still holding up, and yeah, you're seeing headlines, but it's kind of like a small contributor. Technology is a small percent of the labor force, even if it is generally higher income. And you've got all these different kind of fiscal programs still to support spending, whether it's the IRA from like a green side of things, and battery plants are going to continue to go up, whether it's the CHIPS Act. There's a lot of money still, I think, flowing through from the fiscal side, which of course makes the Fed's job more difficult given it only has this one tool. So I don't know. I just, has anyone seen any like live data showing that there's a significant deterioration in economic activity off the back of this bank run? Yeah, so just to kind of share who it was, Gavin Baker. He is a CIO at Atreides Management, and he had made the comment yesterday, quote, "No impact to credit card spending over the weekend from the SVB collapse. Consumer spending continues to be relatively strong. I will admit to being surprised, and I'm curious to see the data from this week." So, yeah, I mean, for now, it's maybe we're just still too early to see if this is going to finally shake consumers out of their spending habits. But I don't know. Again, we're kind of talking about all things related to this bank crisis and the rate volatility. We talked a little bit about a couple other tickers earlier. If anybody wants to share any different trade ideas, we can kind of go in that direction as well. It's 5:10. We started a bit over an hour ago, so we'll keep the conversation going for another 20 minutes at least. If we get lively again, perhaps we go to 6. But the floor is everyone's. Whoever would like to chime in. I obviously noted, in my personal account, I thought some of the value stocks that I'm invested in, like British American Tobacco, Allison Transmission, PBF Energy, I think a lot of them traded down meaningfully. And again, I don't know how much of it is just like rates and this market being kind of funky, because I'm not really a tech investor, and I'm watching as I continue to trail tech over the last few days, and it's a little frustrating. So I don't know. Anybody YOLOing into Nvidia at these levels?
I sold a 0 DTE call on NVIDIA.
Can I ask, Ross? Sorry, are you now? How do you say? Did you just say before that you are bullish in tech, or?
Oh, absolutely not.
Okay. Okay. Okay, you said okay. You meant that you don't understand the move since last
I
Friday. Yeah?
sort of get the mechanics why if rates
okay.
drop along the curve that people may mechanically. I let me see if I can find it, because somebody kind of made the point that part of it was just positioning. You know, people were, I guess, relatively speaking, overweight value, underweight growth / tech. And that's why some of this has happened, because of the rate move kind of forcing that gap to get closed. I don't hyper obsess about the short-term moves too much, but like, again, I'll use Allison Transmission as an example. We're talking about an industrial company that makes automatic transmissions for commercial vehicles. The commercial vehicle space remains strong. The commercial vehicle space still has a big backlog of equipment to replace that it did not produce during the lockdown periods and during all of the supply chain issues. So when I look at a player like that and I see that it's trading, back down close to its lowest ever forward operating multiple, I am perplexed insofar that the outlook is actually pretty favorable, and yet the valuation is going in one direction, and it's down. So it gets back to, is there a big problem coming in the economy that I am missing, or is there just a lot of herky-jerky noise going on with all of the volatility in rate markets and these kind of wild moves down in rates? I'm inclined to think it's more the latter.
Yeah, I mean, what I find interesting is I think the problem is the market participants are kind of conditioned, right? When rates go down, then we need to pump tech, kind of, right? But I think because most people never experienced a recession, that they don't understand that, because last week, at least in the rates market, that there was recession fear, right? So, I mean, to buy tech during a recession doesn't make most sense to me. Exactly, but like I said, I believe it's just that people just don't know any difference. That okay, if the central bank does this, I go long. If the central bank does this, I go short. Yeah, I think that might be also a factor.
So since I know some of the folks who are trying to join from Android are having difficulties, Sick was asking about kind of what happens with the smaller banks, and what happened to the stocks. Again, I am not a bank analyst or expert, and what I would really say to people is, if you are not a bank analyst or expert and you haven't spent time on these, you should really not be touching them. That said, I understand why people might be intrigued by these, and the reality is a lot of them are probably going to have to raise capital, and that is what, of course, kind of set SVB over the edge when they came out and were trying to raise capital, and effectively that preceded the bank run. So I think once things cool off a bit, though, you're going to probably see a lot of these smaller banks raising capital, which, if the valuations are down at these levels, it's obviously not great for long-term shareholders. I know plenty of people are trying to trade around the volatility, but again, if you're talking about trading a sardine that could quite easily go to zero overnight, unless you have some deep insight into the bank's balance sheet and you've really dug into it, I just think you're probably not making the best risk reward driven decision. That said, I did note I worked at Bank of America for about 6 years. I've always been very impressed with Brian Moynihan's leadership, and the bank, I think, is meaningfully less risk taking than it was in his predecessor's days. They've, of course, I'm sure everyone's seen, like, they have a lot of held to maturity losses. I'm not so concerned about them, and I do think that the equity, which of course Warren Buffett owns a lot of too, is fairly attractive. And I put a small position into Bank of America, writing the volatility. But again, that's a big systemically important bank that is for all intents and purposes not. I think if Bank of America and JP Morgan Chase, Wells Fargo are failing, I think we have far greater problems. In fact, I don't think they're going to be allowed to fail or would be. But there are very real questions about what is the relationship between like equity for banks. Like, is banking going to be forever changed from here forward? And there's just more questions than answers. So, I mean, I'm still very underweight banks. It's just a smallish position in BAC for me in my personal account. Other than that, I have no exposure to banks, and I think people should be very leery about dipping their toes into a pool that they don't know how deep it is and they don't know what it's filled with.
I said, Rod, do you actually know this one chart that I think Zero Hedge and also many other guys actually shared with respect to how much held to maturity securities and available for sale securities losses all of the banks combined have currently? Do you see this one chart?
Yeah.
If not, I will dig it out. No problem, and I'll put it in the nest, and then we can talk about it.
Hey, Rod, I had a question for you. I guess we had earnings season just recently, last few weeks, and there were certain expectations, for how companies would do, and if we were really in a recession. What's your like look in review? What's your kind of view on that?
We're not yet in an earnings recession. I think the outlook is probably still a little too rosy. I'm trying to pull up where we're at. Okay, so the S&P 500, and I've made this point, I think, pretty consistently, that I have a view that the large caps are the least attractive segment of the market, which, has not borne out in the last couple of weeks with how the Russell has gotten absolutely bludgeoned. Again, I made the point about NASDAQ's up almost 6% over 5 days. Well, the IWM is down almost 3%. So almost a 900 basis point spread between, mega cap technology and small cap. So, today, small value was down 3%, large growth was down 70 bips. So, again, it goes back to, I don't know how much of this is just yields driving flows rather than like the underlying fundamentals. But I'm seeing that the 2023 estimate for S&P is down now to 221, 222, which would still reflect earnings growth. And I don't believe that happens in 23 versus 22. Now, granted, remember, these are nominal numbers. So if as inflation continues, you do have that kind of effect. But when I look at the market calling for basically a 1% growth in earnings for full year 23 versus 22, I think that's still way too rosy. And there's probably more earnings markdowns to come. But in terms of like the company seeing it yet, you see pockets of stuff like, and we talked about Walmart seeing more high income people, shopping with them, and the continued shift away from discretionary towards staples. The thing is, you had earnings go from, in 2018, 2019, it was 162. And now earnings jumped all the way up to 219 last year. And like when you look at the long-term trend line, it just seems incongruous that there would be earnings growth or not an earnings recession. And I think you can have an earnings recession where markets, financial markets, feel some pain, and you don't have to have a real economic recession for the real economy. So you could have that, and I would not be surprised to see an earnings recession in 23 still, which is not really priced in, and the underlying economy not necessarily dip into anything more than a modest or mild, recession, or even just below trend growth, which is of course the holy grail of the soft landing, where there isn't negative GDP growth and meaningful upticks in employment. But the results, like when technology results came in, they were kind of meh, right? And then the tech stocks shrugged it all off, by and large. So I don't know. It all gets back to, until there's a meaningful uptick in job losses, though, things should keep trudging along. As long as people can service their debts and continue to spend, they'll continue to do just that.
Rod, I added a tweet in the nest. It's not from Zero Hedge. It's I don't know this guy, but if you click on it and if you look at this chart, you can see that I think it says that the bank's total losses so far, as at the end of 2022, is $620 billion. Yeah, like if you put together the available for sale and the held to maturity securities together. But the problem with this is that it only shows one leg, right? It only shows, of course, because back in the days, I mean, it's not so much back in the days, right, when we had 0% interest rates and they had to invest in longer, in longer term bonds. But most of the banks, they have duration matching, right? I mean, they enter a swap, right? And interest rate is almost 100% hedged, right? So this picture looks super scary, but this is like showing only one half of the coin, right? Because behind that you have swaps, and those bars would be much smaller, maybe just 5% of the overall exposure, right? Because I can totally believe that, of course, you don't 100% hedge, right? You still want to have some direction and make some profits. But this I have to say, because this is a very popular picture that was going around the last couple of days.
Yeah, that's
so
a really,
I think this is
really
really
vital
panicking.
point, that it's not a complete picture, but it is something
Yes.
that a lot of people are jumping on, and people like to be hyperbolic, especially to get likes and shares on Twitter. And as you know,
Sells.
I like to be nuanced and measured, and it's not as exciting. But you're absolutely correct that we don't know unless you have done the work on that bank, and even then, to the extent that they have it in the footnotes, right? I'm not a bank analyst. I don't know how much of those hedges are even getting fully disclosed. So there's a lot of uncertainty. I think is just the problem, the issue, right? And that's where the regulators have sought to diffuse some of that uncertainty to the extent they can, and try to restore confidence, with the actions taken by some of the leading banks, with the FRB backstop this week, and obviously the regulators' actions on Sunday. So yeah, I mean, you're right. There's people like, I think even back to, and I asked this question on my personal account, I had done a survey and I said, how much of the bank run was a byproduct of social media? And the answers were across the spectrum, but actually a lot of people thought, a plurality of respondents thought that somewhat or a lot of it, 2/3 of respondents basically answered somewhat or a lot of the bank run was a byproduct of social media. And the reality is we never used to have Slack chats where venture capitalists managing tens of billions of dollars are talking to dozens of each other and basically tell one another, by the way, we're all depositors at the same bank and we're going to pull all of our deposits. Like, SVB is clearly idiosyncratic in that regard, in that it had that depositor kind of risk, that flight risk. But the way it unfolded, again, I will be curious to kind of see what studies come out to try and quantify how much of the bank run was fueled by social media and fueled by kind of these reports. If people are responsible, and I hope that they're held responsible and face penalties. That goes for Mr. Thiel. If so, I have no insight into whether he is liable for it, but it sure doesn't smell good.
Yeah, and I have to say, Rod, I totally agree with you. I heard from the Macro Hive guys that the last famous bank run I think it was 2007 Northern Rock. Actually, I think within 2 weeks, I think 15% of the deposits were pulled out. Yeah, and with SVB we had 25% in a day. And this is exactly what you're saying, right? You have WhatsApp groups, Slack groups, and whatnot, right? So it's so much faster than before. And also, you would not even go to the bank anymore. You would do it online, right? So everything is
Right.
so
You
much
didn't
quicker.
have a smartphone app in 2007 to transfer out everything because you didn't have a
Yes,
smartphone in
correct.
2007.
Yeah. So I guess the future stress tests, they also will have to incorporate this kind of technology going forward.
And obviously it raises the cost for banks to retain depositors, right? I know there's reporting on various different banks raising their rates on 1-year CDs and maybe even just their savings account products because the reality is now that the kind of the cat's out of the bag, and I think many consumers who hadn't been thinking about their cash positions are going to give it a lot more thought, and maybe they're going to actually go and try to find a better yield. Again, FDIC insured yield. So there's still a lot of uncertainty. I think going back to the whole big bank versus small bank, it's hard for me to see an outcome that doesn't result in it. And the report has already shown, right, that Bank of America noted, or not that they noted, but someone noted that they had received, and this was out, I think Thursday, like 15 billion in net inflows. The other big banks, Citi, JPM, also getting big time deposit inflows, and that's good for them. But maybe that's not so good for the entire banking system. So I don't know.
Yeah, I mean, with respect to the macro, I also heard this argument, which I have some sympathy for, that because when you have so many regional banks, they actually also support the regional businesses, right? The smaller, what is it called, the mom and pop shop kind of, right? And if they actually struggle, then also the regional, how do you say, the smaller companies will also struggle, which are the backbone of any economy, right? So that's why, in a way, I mean, a small bank is not systemically relevant, but all the small banks in the US become systemically relevant.
So I retweeted Joe is the bank crisis over from my personal account. So we're now up to 91 votes, and now it's 80% said no. I voted yes, by the way. Me being the contrarian that I am. I think the crisis is actually over. It ended Sunday night. People just didn't realize it yet. But thus far, the masses are of the view the crisis is not over. And I guess it depends on your definition, right? Clearly, the issues going on with Credit Suisse are not resolved. So in that sense, you could say that the crisis is not over. I'm kind of thinking about it more from a, I guess, bank U.S. centric lens, and being the American that I am, and I kind of view it as over when I view it through that lens. But I could certainly appreciate the no respondents.
Can I ask you, Rod, like what do you think will the Fed do on Tuesday next week? 25 or
yeah,
nothing?
25.
Oh,
25.
25, okay.
They're going to do 25 unless there's another, big blow up between now and then. And yeah, I mean, ECB moving forward kind of, I think, not that it forces them, but I think the message it sends to markets that they continue hiking is better than the message it would send to markets if they paused. If the Fed were to pause after all of this, in lieu of the still too high inflation and still too hot labor market, I think that might raise more fear than anything else. So I think they do 25. I think that's pretty much assured, barring barring me being wrong that the crisis isn't over. And then clearly the market is now pricing some pretty swift cuts. I'm not so sure about that still. That might have been an overreaction, but it goes back to your point, and it's just incredible. These swings are not normal at all. These are literally swings that happen once every couple decades. So I don't want to say unprecedented, but not far from it.
No, you're right. There is actually a chart that I'm seeing, like the move in rates, like last week was really like once in, the chart goes back until 1993, we didn't have such a move. So really,
it was the
in
80s,
a couple
I
of
think,
decades
early
even.
80s.
Yeah. It was
Which
crazy
I wasn't
moves.
around then.
Yeah. I have to say, do you know Dominique Duofreco? And I'm sure that I pronounced her name completely wrongly. She's from Macro Hive, a chief economist, and she thinks that the Fed will not hike in order to signal to the market that they don't want to put any extra stress on the banking system. But I agree with you with the 25 basis point hike, because you still want to signal. Actually, by not hiking, you might also signal to
If
the
you
market
don't
that
hike,
there's
you
something
signal
wrong.
there's a really big
Yes,
problem. Yeah.
exactly. So you still hike, but you can still hike a little bit less than the ECB. And so that's the compromise that I was thinking of.
Well, we'll be back next Friday to dig into what the SEP looks like from this meeting. I'm gonna just pull it up real quick to kind of refresh. And this was last updated in the December meeting, so a lot has changed since then. Their dot plot, I think, will be, that'll be one interesting one, where they think the unemployment rate by year end comes in, because they thought it would be 4.6% in December, which was up from 4.4% they thought year end 23 would be in September. And obviously, it's still pretty far off of that level.
It's
So,
3.6
we're talking
now,
about we're talking about over 1 million people incrementally becoming unemployed in that estimation. So I'll be interested to see what happens in those changes. And then, the dot plot. One other thing that still is, I doubt they change at this meeting, but if you think about it, the long run, they continue to kind of hone in on this 2.5% as the long run target. And it's kind of like, okay, if the Fed continues to say that it's too low. Yeah.
No, I was saying that the long-term target of inflation is 2%, not 2.5%.
The long-term target of inflation, yes, is 2%. But I mean, there's a lot of discussion around whether that is truly achievable without a painful recession, and maybe more painful than necessary. So I don't know. I doubt they're going to move the longer run Fed funds target rate up, but that if they were to do that, that'd be an interesting thing to see. But for now, year end, at that point in time was above 5%, and now the market is saying no. So let's see how far off the Fed comes versus what the market's pricing by then.
Yeah. I mean, the problem is also with the labor market that in order to be just flat, right? I mean, because the last time NFP was negative was, I think, during COVID, right? I mean, we don't need to be negative, but I heard something along those. I think Goldman was saying that if non-farm payroll changes are around 100 to 150K a month, then this is like that the unemployment rate stays roughly the same, because there are also 150K people a month who actually retire or quit, right? So, and we were not even close to that number yet, right? I mean, we had in January 504K and last month 311K, right? We are so far away from this 100K number, and we need to go below that number in order to put more pressure on the labor market. So this will be very interesting to see in the next couple of months if we can get NFP changes towards that number, or better said, below this number.
Yeah, and I think I noted last week that if you look at some of the, maybe it's more live data on like openings, whether it's from Indeed or from LinkedIn, as opposed to the JOLTS, which is a very lagged and kind of
Yeah.
wonky metric, that you can see that those are coming in and coming down. So it's just a matter of, I look at, not to what is it? Not to use the phrase everyone uses, right? There are long and lagged effects of monetary policy tightening. The Fed tightened, from basically 0 to almost 5 in 12 months. So we haven't even felt the full effects of that. I think most people would agree, and it seems that it would be imprudent for them to come out with an aggressive tightening message incrementally from here, given the totality of the information. I mean, you're 100% right that the labor market is still too hot. It's still not in line with the Fed's mandate, but it's going there. It's getting there. The tightening is working its way through the system. It's just a matter of, I think, it's just a matter of patience. People are, we see all these default rates kind of ticking back up toward normal levels in some spaces. We see, as we kind of called out, I think 2 weeks back, the subprime automotive space really feeling stresses and GFC levels of delinquencies. So there's clearly some stuff going on that should help bring aggregate demand in, even if the Fed doesn't have to raise more than another 25 or 50 total from here. And then, of course, right, once they're there, then the market's saying they're going to cut pretty swiftly. Unless something else like breaks, or unless the real economy starts to meaningfully decelerate, I don't see that they're going to cut as swiftly as the market is pricing right now.
Yeah, I agree, and also because we think very US centric, right? Like if we look at China, we have an economy in a complete different state, right? I mean, they cut triple R, the reserve requirement ratio, right? So banks don't need to hold so much capital anymore, which will also boost the economy. So they are in boosting mode, right? Whereas Europe and the US are in tightening mode. Then we have Japan, which are maybe entering the hiking cycle finally, right? Because it's still negative 0.1%. I think the I think the policy rate there. So it is a very awkward environment, right? You have so many regions in a different state. I mean, usually you would have a global recession or a global recovery, right? But this feels very different this time.
And that's totally true. Even within the U.S., you have certain sectors. I made the comment about truck transportation employment, and the freight market is still kind of going through a recession right now. You can have a freight recession and not have the entire economy in recession. You can have certain sectors in recession, and that seems to be, I think it's the consensus at this point that there are going to be some sectors that have their downs, but that doesn't necessarily mean that the entirety of the real economy will be in a NBER defined recession. So yeah, you're right. It's clearly different countries there are different points kind of in the cycle, and then different sectors within those countries have different puts and takes. So it's a really noisy environment, and I think that's why if you're investing in individual companies, you should probably focus more on those companies and their competitive landscapes and the like, rather than obsessing too much over the macro stuff, which is obviously always top of people's mind and fun to do, prognosticate. But it goes back to what I was saying about when I think about some of these industrial companies, I don't see why they should be trading down towards some of their lowest multiples on record, in light of the big backlogs and the solid amount of clarity that there needs to be replenishment of these various pieces of componentry. So yeah, but we'll see how it plays out. It's 5:40, and I know I had said we'd wrap around 5:30 or we'd go to 6. So I'll if anyone wants to get any final thoughts in, come up and share a question or get a last
I got an
word
update.
In. Yeah.
Related to Bed Bath & Beyond. I know this is kind of like a meme stock, but they just announced that they want to have an annual meeting for a 5-to-1 or a 10-to-1 reverse stock split.
That's clever. They think
I've been waiting for this.
Yeah.
Yeah,
So I'm sure Hudson Bay Capital will want that to go through so they can lure more rubes into their. I'm sorry, that's not nice to say.
Yeah, it was really interesting because I saw the bonds trade down a lot, like maybe 30-40% down. And I was wondering why and if there's any material news, but I guess this is the material thing, right? That they kind of recovered a bit, but still, it just shows. I guess it's a sign of distress, right? No, people really don't like reverse stock splits in general, but maybe they can raise more, just like AMC did or is doing.
Yeah, I have it on my screen that I'm sharing. I'm looking at the proxy statement that came out. Oh, no, this is not from today. This is from the 14th. I'm looking at the wrong thing. I don't know why I just pulled up a completely wrong company. But you said Bed Bath today. Let's get that pulled up. But Steve, hey there. Go ahead.
Hey, well, happy St. Patty's Day. This is not related to Bed Bath, so if you want to put it on the, if you want to finish that thought first. I was just curious. I saw banking in the top, and on a week of just absolute freaking panic and craziness, SoFi is positive. I was curious what Wook's opinion was on our generation's big bank.
I don't have any informed opinion on SoFi.
Thanks.
We've talked about the banks a bit, though, and I think I made the point that anyone who's unacquainted with the ins and outs of the balance sheet of the bank they're trying to dip their toes into should really give it a second thought. And if you've not done a lot of work already on banking or on banks, look, I get people like to trade and speculate, but there's a lot of murkiness and uncertainty in that sector, and people should probably steer clear of it if they're not too informed on it. But I'm sure they'll keep trading it, and I'm sure there's money to be made. But I just think that the small banks in particular, I think, are going to have to raise capital. A lot of them, maybe even the big banks. Who knows where we end up from here? But if capital is getting raised at depressed or reduced valuations, that's not bullish for equity holders.
Appreciate it. And then one final question. How many Rabbitars do I need to own to effectively just buy PLBY at this point?
Those aren't going to get you there. It's look, it's we talked a little bit about PLBY earlier. So to your point, the stock closed at an all-time low, and $1.74. There are 73 million shares outstanding, so the market cap's 127. There's 50 million in preferred stock. It's coming up on the 1-year mark, so let's call that 55 million. Then you've got to add the net debt is around 122. So that gets you around 304. Let's round it down to 300 million for the enterprise value. So the problem with that idea is that you have one shareholder who owns 30% and has an investor rights agreement, and effectively has, if you were to make an offer, that Suhail Rizvi could just say, I'll match it, and have the board vote, for it. So it's kind of a little bit of a catch, I don't call it catch-22, but there's not really an easy way to do that. I know you're, obviously being playful with the Rabbittar part, but I maintain, I am convinced that the sum of the parts is extraordinarily disconnected from the value here. And it's not to say that it won't trade down further, or that the resolution will be favorable from here. But I do think that equity returns multiples from this level, which again doesn't do anyone any good who has a double-digit cost basis. But forward returns have named the game. So you had one analyst capitulate today. Brian McGough, who I have a lot of respect for Brian, and I've had a lot of conversations with Brian over the last several years. So I think he's just kind of over it, which, Ben Cohn, unfortunately, is the dingleberry that sticking around, the CEO, and that's the real problem. The day he resigns, the stock likely rallies 30, 40, whatever percent. So I do think, though, it's on a timer. As I mentioned, they have their covenants waived through the second quarter of 24. And should their creator platform not grow at the cadence they laid out last night, that they will sell everything, is what I expect. And I expect that selling everything, as I noted last night, the chairman has a view that in a sale, it would go for between $7 and $10 in liquidation. I'm on the low end of that, maybe $6 to $7. But again, that's a lot more than $1.74. So, and that's literally just selling everything. Obviously, if they do succeed with the creator platform, they won't need to do that, and they can fund the business with that cash flow. And maybe Ben gets to survive this, but yeah. All right. Hopefully that's helpful for you, Steve. But 546, Giro, Chris, any final thoughts that you guys want to share, or anyone else who wanted to really get a last question in the audience?
Maybe just a quick logistics question, because I tried to join via Discord, but then the problem is that I think I'm kicked out of Twitter, right, when I'm in the Discord channel. Is it correct?
Oh yeah. If you were to try to use one device,
Yeah. Okay.
Yeah, we've talked
good.
about this, and unfortunately, if Elon's not going to fix this platform and not going to let Androids use it, we may eventually shift over to YouTube. I'm not certain, where we go from here. I like Twitter Spaces. I think it has a ton of potential. I just don't understand why it's seemingly not being, made that we can do things like screen sharing and the like. And who knows? I can't hand off a host to somebody else. Yada yada. You guys have heard me rant about this before. But yeah, Chris, for Bed Bath, so they're going to do you said 5-for-1 reverse split.
It's at the
I see
discretion of
it.
the board.
Oh, I see it.
5-for-1 or 10-for-1.
Or 1-for-10, yeah.
1-for-10, yeah. The other way, yeah. So
shareholders of record on the 27th will be entitled. So it's again, it goes back to the thing we've talked about a lot in these discussions, that these meme stocks, when you have a very high retail ownership mix, retail doesn't tend to vote in corporate actions. And knowing, though, that you've got Hudson Bay Capital as the owner of all these preferred stock and warrants, I actually don't know, and maybe you do, kind of how the voting structure works for that. Because will Hudson Bay basically be able to get like a lot of voting rights by virtue of the securities sale that happened in February?
Maybe. I mean, from what I've read, I don't think the preferred shares have voting rights, so they would have to convert them, I think. And I don't know if they can just convert them, like a bunch of them, like right at the deadline date.
Yeah.
And vote and then sell and hedge, right?
That's right. So they've got, I guess, sometime either next week or the week after, then there could be some more craziness in the shares if they decide to do something like that. But yeah, if they don't, again, I don't know the ins and outs of Bed Bath's specific situation, but I would be inclined to believe that the largely retail investor owned equity is not going to be able to get a majority of votes, cast as a 4, which is the problem that these other companies we talked about have run into with all these, peculiar preferred stock issuances.
Yeah, I mean, speaking of AMC, I mean, Antara sold 48 million shares this week. I don't know if you mentioned that.
Of Ape, right?
Of Ape, yeah. And they had that special deal with AMC, right, where they could vote and basically make this, thing pass, like by getting these shares for really cheap. Hudson Bay deal is a little bit different, but I think it might be possible. I mean, they could sign a different deal with Bed Bath, right, and get a bunch of shares. But I think through this deal, they still get a great price. They can hedge with options. The options are pretty liquid, it seems.
And that's really it, right? I mean, I think you and I talked about, we thought it was effectively that Hudson Bay was looking to monetize the volatility that, Jake Freeman proposed that the company monetize, the company failed to act. And instead now you have a third party that's, monetizing the volatility, which, is at the, I guess, to the detriment of the existing common shareholders who've, basically been wiped out at this point. But yeah, I'm looking at implied volatility for Bed Bath for the 30-day implied vol is over 200%. And that's down from where it was before they made the deal with Hudson Bay, because the 30-day implied vol was over 300% in Jan and February. So, I mean, Bed Bath is still just a volatility token. And I think HBC is doing its best to monetize that. And, the operating business, right, we'll see. I tend to think they're not going to make it still, unless they can keep raising this capital.
Yeah, which is the reason why we're seeing this. I mean, they wouldn't do it unless they really needed it. But yeah, I mean, they've knocked out, I think, $360 million worth of debt. I think most of that went towards debt, and then the coupon payment was like 24 mil. But if they can knock out more of this ABL debt, at least in a distress scenario, right, unsecured holders can get something back.
Yeah, your bonds might get more, but unfortunately,
that's what I'm
people
hoping.
Who keep piling into the common stock, it's just really sad.
Yeah, I mean, that's just how these things work. I mean, if you own equity in a business that's failing, that's very, very distressed, it's not like really like you own the business anymore, and you own the shares, but you don't really own the business. There are other interests that really get to dictate what happens, but you do get to vote for this reverse split, whether it goes through or not. But either way, right? Like, it's not.
I mean, I'm gonna say right now, knowing that institutions have largely abandoned the security, and knowing that the longstanding issues of getting retail shareholders to vote en masse, I'm sure that Bed Bath will concoct another scheme with HBC. What exact form it takes, I don't know. But seeing, if the share reverse split is not approved, the company may put the adjournment proposal to a vote in order to seek time to obtain sufficient votes, yada, yada. So in such case, the company may be unable to meet the reservation of securities requirements set forth in the Series A convertible preferred stock. So if they don't get a yes vote, right, then they may, if they get that price failure, it's just not good. So anyways, we'll keep watching. But thanks for sharing.
For sure. Yeah, I just I got an update in the Discord, and I just wanted to share that with everybody. I don't know how many people really care about Bed Bath. It's kind of
this is an update, by the way, Chris. As of March 15th, we had 335 million shares of common stock outstanding. Did you see that?
I did not see that. No, 335.
So the folks who are in that may be interested to see how much dilution has been happening.
Okay. Yeah, they have another 600 million in the treasury.
So they have 47 million held in treasury and 335.4 million outstanding, which, to your point, they can issue up to 900.
Yeah. So they have some ways to go. I mean, it's why not, right? I mean, from the management's perspective, right? They need to save this company as much as possible, in a Chapter 11. If they can't afford to, pay for all the expenses, this thing would, be in trouble.
Yeah. I'm just want to do the math real quick, because I don't remember what the shares out had been at the prior
117 million.
Okay, so over 200 million shares. So the shares outstanding have already tripled. Okay.
Yeah.
Wow.
How is the stock reacting to this right now, by the way? We see this.
In after hours, it's down another 12 cents. So it's down to 91 cents. So they're going to have to amend that.
They need this.
That's unfortunate. So it's interesting, right? That the market cap is actually, even at 92 cents, because of how many shares outstanding there are, the market cap's actually over 300 million still.
Yeah. So they just need a reverse split and then sell more.
Yeah.
So,
all right, cool.
Yeah.
Well, look, it's 5:55, so just to kind of let folks know. Oh, all right, we got Giro. I see you just shared that UBS is in talks to acquire all or part of Credit Suisse per the Financial Times. Yeah, as we were talking about it, it clearly looks like this weekend something's going to happen to resolve the Credit Suisse situation. So that's the newest tidbit of information that we've got on that one. Yeah, so we will be back though next week. We won't be back with our Wednesday open mic. We're going to skip that this week. I'll be on vacation, but we will be back next Friday. So we'll be able to round up what happened with the Fed, presumably what resolution we see with CS, whether the state side we get we get any more bank issues, or if we get the Fed to go ahead with its 25 bips, as I think most people and the market are currently expecting. And yeah, we'll be here to talk about it next Friday at the close. The following week, we will be back on Tuesday, the 28th, with our book club series. So 8 o'clock Eastern on Tuesday night, we're going to talk about Joel Greenblatt's the little book that still beats the market. So we're going to have that coming up, and then we'll be back with our normal slate of the Wednesday open mic calls that I host on my personal account at 7 o'clock the following Wednesday, just not this Wednesday. I'm going to be celebrating my birthday. I'm going to be in Atlantic City. I am going to be doing my own speculations and gamblings at the craps table at Borgata. So I will look forward to catching up with everybody. Hopefully I've not drawn down all of my reserves after my trip to Atlantic City, but maybe I'll get bailed out if it's banking jokes. All right, everybody, it's been a pleasure as always. Thank you very much for tuning into this edition of our Wook Review, and we look forward to catching up with you next week from the Wook Capital Management team. Thank you again for your interest. We look forward to continuing to crowdsource research with everyone in going forward. Cheers, everyone. Have a great weekend.
Great weekend. Bye-bye.